Hey everyone, Douglas here, and welcome back to the channel. And let's see, pretty wild ride today. Actually, pretty wild ride for the past few days in the markets, and at least in the equity space. And I think we ended up about 1% today in the S&P at least. But yeah, this week kicked off with a ton of selling and a lot of volatility. And at this point, I don't know if it's necessarily over. We'll have to wait and see. But yeah, I don't know who could have saw that coming. If you are interested, though, I think my take still very much stands in terms of the recent selling. So I will put that in the card above if you haven't watched that yet. Anyway, today though, kind of the big news today was the Fed rate decision, and that will get us into the topic of this video. And as expected, the rate remains unchanged. There was no change in the actual interest rate decision, but what everyone was kind of paying attention to, and you know, it didn't have 100% assurity of, is kind of two main things. Number one was, when would the Fed start their tapering schedule to begin to roll back some of the programs and the asset purchases that they did after the COVID crisis. And then the second big question is, how is the Fed seeing inflation, and how is that impacting the potential timetable for rate hikes in the future? And so those are the two things that investors were trying to glean from not only the rate decision, but the statement that happens afterwards, and then the press conference and questions after that. And it's really an inflation point that I'm going to touch on in this update, because Chairman Powell multiple times mentioned how that no matter what happens to inflation, if inflation, at this point, the Fed still sees inflation as transitory, and that it will go away in coming months and settle back down into kind of their normal bound. But he said if the Fed does feel like inflation, is going to start to get out of control, that they feel like they do have the tools necessary to fight inflation. And look, the Fed takes a lot of flack from all sides of kind of not only the political spectrum, but also the economic spectrum, and academically and all that sort of stuff. And I really think a lot of it is unfounded. They don't exactly have all the tools available to them to do what it is that they are, charged to do. And yeah, I'm not a Fed basher just for the sake of bashing the Fed, but when it comes to inflation, and it comes to the statements that Chairman Powell said today with regards to he's certain they have the tools necessary to fight inflation, I 100% disagree. I really think that the way the predominant academic economic theory views inflation, and the Federal Reserve's understanding of inflation and how they would fight inflation, is like exactly the opposite of what they should be doing if in fact inflation rears its head and becomes uncontrollable or something like that. And it really rests with particularly setting the interest rate. So a couple things there to kind of piece together. But the big takeaway is I really just think a lot of people, a lot of different kind of schools of thought, just don't understand inflation properly. And I really think MMT is kind of the one school of thought that really has a proper grasp on inflation. And then more importantly, for kind of traders and investors, where I'm at, I really think in terms of the inflation discussion, it can make it very easy if you understand kind of the MMT take on inflation. All of a sudden, the inflation discussion just becomes kind of background noise, and not something that is this terrifying beast that can destroy the economy. So, I mean, not that it could destroy the economy, but the likelihood of it happening, given the way that the Fed kind of currently looks at inflation, seems unlikely at this juncture. So with that being said, that's going to be the topic of today. So hey, if you are new here and you haven't yet hit that subscribe button, make sure to do so, and turn that notification bell on as well. That way you will be alerted to whenever I post something, to anything new that I put up on the YouTube channel. And it'll go right to whatever device you have linked up with your YouTube account. And then if you find this video particularly helpful, make sure you hit that like button as well. It lets me know you like this video, and then it also really helps the YouTube algorithm get this video out there, extend the reach of what I'm trying to do here, and kind of just keeps me encouraged to keep making more content here on the YouTube channel. Anyway, let's see. Let's dive in to kind of nuts and bolts, and then also understand what's on the screen here as well, and try and make some sense out of this. So, Where to begin with inflation? Let's start with kind of what most people understand when they think of how the Fed is going to rein in inflation or how they can spur on inflation if that's what it is that they want to do. So kind of general theory goes like this, that the Federal Reserve, the main tool they have for inflation is controlling interest rates, right? They can set the overnight interest rate, and that will set the path for interest rates, and supposedly that's going to control inflation. And the idea goes that if they lower interest rates, right, that's going to spur on more loans because individuals and businesses are going to be more willing to take on more debt, which is going to spur on growth, and that will spur on inflation. And so that creates kind of this growth inflation cycle, and then businesses will hire more as they expand more, and you just get this booming hot economy with low interest rates, right? And then the thought is, as the cycle goes on and as the economy gets too hot, they will raise interest rates to unravel that, right? That businesses will then slow down in terms of creating loans because the loans will be too expensive, and they can slow down the economy and let some steam off by raising interest rates. And so that's the general theory. The problem is the general theory has never actually played out that way. The Fed is just always like off on their view of inflation in terms of where they expect inflation to be and how they, what their own prediction is of where rates are going to be. And it's just not a model that has worked out. They've had, zero interest rates or near zero interest rates for over a decade now. And, very little inflation has creeped up during that amount of time. And it took a massive fiscal stimulus bill and a shutdown of the entire world economy to finally get any sort of inflation in place. And even then, that kind of looks like it's starting to wane. And that's kind of my take is, as I think in due course here, we will see a more disinflationary push into the future. And so as it turns out, low interest rates just don't push inflation higher. And the time that we've actually seen interest rates really spike up was the late 70s into the early 80s. And that happened during a high inflationary period. And I would argue, and then we'll kind of make the case by the end of this video, that actually pushes inflation higher. And so the MMT take here is that really low interest rates or near zero interest rates are actually disinflationary, right? And higher interest rates are going to actually drive inflation higher. And this was first kind of realized. This idea was realized first by the person that you'd expect it to be first realized, and that is the father of MMT himself, Warren Mosler. And I know I ran across this a handful of years ago. His presentation on this a handful of years ago at a conference, and he kind of spelled out what he called the term structure of prices as it relates to interest rates as kind of the academic definition of inflation. And if I can remember, and that video is still up, I will link that video in the description below so you can get the full context of what I'm about to show here and demonstrate here. But the idea that Warren Mosler was trying to get across and is that really what interest rates are doing is they're really setting the price of business into the future, right? In other words, if interest rates tomorrow were set at 100%, right, and so the entire curve would obviously just shoot higher at that point. From the shortest term loans all the way up to the 30-year bond, and that would just fire higher, right? And what that would do is if you were going to build a building or start a business or hire some employees or whatever, the decision would, or the calculation you would make in terms of, well, what's the cost of business going to be next month, next year, et cetera, you'd base that on the cost of your borrowing, right? That would be priced into the cost of doing business. So the higher the interest rate, the more expensive things are going to get into the future, okay? And as it turns out, this whole concept expands across the spectrum of kind of all goods and services, right? And it's very visible. And then again, this chart here to the side, right there we go. The chart to the side will demonstrate that in just a second, but what we consistently see is when the Fed starts to plot out that, hey, we're going to start to hike interest rates soon, and interest rates start to push higher, we actually see inflation take off, right? We see the Fed actually lead the way with inflationary pressure, and inflationary pressure being defined as what the cost of business is, going to be tomorrow, but what that is today for the person making that investment. Because this is a tricky part. He mentions that in the presentation. If you watch it, is all the definitions that we have of inflation are never of what is inflation today. It's always, okay, what's inflation been over the last 6 months, measured, some sort of price of good or service 6 months ago relative to today, right? And so you can say, hey, this is how much prices grew, or this is what the inflation rate was during the past 6 months, or if you guess that prices are going to be X amount higher than they are today, you could say this is what inflation will be in the future. But they can never say, okay, what is inflation today, and is he defined for the moment? And his proposal is, well, it's the interest rate, okay? And this chart, I think, can demonstrate quite well exactly how that idea plays out. So what do we have going on here? Well, on the bottom, we have TNX. So this is the 10-year yield on the bottom chart. And on the upper chart, we have the front month of gold. Okay, so the front month contract of gold divided by the second month, or the next month contract of gold. And so essentially we have a quasi-term structure of gold here. It's not a perfect demonstration, but it'll get the point across in terms of kind of what I'm trying to elaborate on here. So what do we see happen here? Well, I think in common memory, or in a recent memory here, we can all remember in late 2016, this is right before the election of Trump, and into the election of Trump, we saw a huge shot higher in rates as the Trump administration was going to come in, they were going to spend, and we were going to get this huge growth shock into the economy, and so the rates went up, and if you remember all the way into late 2018, this is when the Fed was even coming out, starting to say, hey, things are getting a little hot. We might go into a rate hike cycle. And so we went to this entire cycle where rates pushed up into 2018, and kind of, your inflation measurements were starting to tick up. And what you can see is the term structure prices for gold begins to expand during this time period. The further out in time you get, the higher the price of gold ends up being in the future. Now, it's important to understand, it's not that gold, would push higher in price necessarily. It did happen to push higher starting in the late 2016 through the end of 2018. It did play out that way as we were seeing kind of true inflationary pressures push in at that point, in part because of interest rates pushing higher. But the point is, the future cost of doing business, in this case, the future cost of purchasing gold, pushed higher because the interest rate was going up, right? And you can see this across any commodity that you put in, across any term structure. When interest rates push higher, you see the future price, you see the trend of the future price start to push up. Now, there are these little blips right here that are just that occur when the front month and the next month don't exactly pair perfectly, but the general trend is up in terms of just the structure expanding out, okay? And then, lo and behold, as rates peaked in late 2018 and then started to plummet through 2019, we started to see the term structure of gold begin to plummet as well. Now, obviously, COVID crisis hit, and everything went kind of wonky there for 6 months, and you had kind of a wild blowout. But it didn't take long for rates to stabilize, and then once they stabilized in kind of late 2020, early 2021, it started to come back down. We started to see the same trend come back in terms of gold. And it's also why, in part, that during the big push that we saw in rates into late 2020, that I wasn't exactly buying any runaway inflation, because we just weren't seeing it in the term structure of prices. I think the run up in rates in late 2020 was far more technical and had to do with kind of internal banking issues in terms of some of the issues for balance sheet capacity that the big GSIB banks had at the time. So, sorry, kind of aside there, but either way, it was kind of only a matter of time before rates started to push lower, bonds higher, and kind of the cycle repeat itself that we've seen over and over again. So that's the gist here, right? There's this term structure of prices that is essentially correlated two interest rates, and the Fed, from an MMT perspective, is the monopoly price setter of interest rates, and the Fed is going to follow what they see as growth, what they see as employment, what they see as inflation in terms of their metrics to determine where they will set rates. So in one sense, it's the dog wagging the tail. In the other sense, it's the tail wagging the dog. But ultimately, the Fed is going to set that rate to the way that they see fit to meet their stated charge as the Fed. And generally speaking, in the current kind of academic worldview that they have, they're going to keep rates low. It's always to their benefit to keep rates low. And so I think, and my conclusion here is that it's going to be very hard to get any sustained inflation that really kind of ravages the economy in any sort of way. Okay, certainly I'm not oblivious to what has happened over the last year and a half in terms of prices, especially over the last year or so in terms of prices. And there's no doubt there's some things that just cost more and will continue to cost more. And when there's more money in the economy and all things considered, that money is going through the economy at an equal pace, at an equal velocity that it was before that money was there. Yeah, you'll get relatively higher prices, but it's not that deteriorating inflation that kind of kills economies. Okay, that only happens if the Fed decides, or any central bank for that matter, or if the central bank doesn't have sovereign control over the currency the way that the Fed does in the U.S., that you'll see that sort of deteriorating inflation that just kind of destroys economies. And I just that seems so far away from the realm of possibility in the current position that we're in now. If the Fed comes out tomorrow and they say, we have a change of heart, you know what, we're going to start jacking rates right now through the moon to curb any sort of inflation. And we don't, we're worried this isn't transitory. And, it is what it's going to be. And we're going to stay at 10% overnight for the next year, no matter what, because we're afraid of inflation. In that case, crap will hit the fan. Okay. I mean, we will see inflation and it will get very, very nasty. But that's not happening. Right now, after the announcement, they felt very confident that rates would stay relatively low. And so, I mean, that's just going to be kind of the case for the time being. And I expect rates to stay low until the Fed gets very, very aggressive in terms of any sort of hiking cycle. And and then, the cycle will play out and the Fed will, eventually want to take rates back lower again at any, the first sign, the first hint of weakness in the economy, and then we'll kind of rinse and repeat. So I think that's kind of what I have to say about inflation and why I'm not really worried in terms of the here and now, and ultimately I think we continue to push lower in rates, higher in bonds, and until this kind of what I see is kind of almost this inflationary cycle plays itself out, and then we rinse and repeat, and we start the cycle all over again. So I hope that is of some interest, and if you have any questions, leave them in the comment section below. And just quick heads up, I've noticed YouTube recently deleted a few comments that they just auto-flagged as suspicious. I saw them, but never got a chance to respond to them. I've turned off YouTube's auto function. I apologize if that was your comment. I think one of them was referencing my nifty little Fred Federal Reserve data repository out of St. Louis, their website. Thanks for the shout out. I appreciate you noticing it. So I will make sure and get to those comments. And if you did comment and got deleted, I promise it wasn't me, and feel free to toss that comment back up, and hopefully YouTube will not just auto delete it. Comment down below if you have any questions or anything like that on this. And again, I'll do my best to remember to link the Warren Mosler video where he will go into more detail on this topic. And so I'm going to wrap things up here and call it a video. But before I take off, if you do like what I'm doing here, you're an active trader, active investor, make sure you check out my Patreon page, patreon.com/CannonMA. It's where I apply everything on this channel for active traders and active investors. You'll get all my trades. You'll get a handful of updates every single week. Take a look at the charts, take a look at the data. Yeah, this recent sell-off that we saw. I mean, I was long VXX before last weekend, and was positioned aggressively for a sell-off. I mean, it's all there, and if you kind of understand MMT, you understand how the banking system works, and you kind of put those two things together, you can get a pretty good grasp of how markets unfold. So check me out, patreon.com/KinnonMA. Otherwise, good trading, everyone, and we'll see you next time. Bye-bye.